Hey, good evening, everybody. It's Julian Alexander, and on staff online with us is our IR team. Of course, we've got Mo, the Wizard of Oz, behind the curtain, pushing all the levers and buttons, and we've got Darwin, who will be speaking here shortly. So, thank you for taking time out of your evening to meet with us virtually and listen to what we have to say. I assure you, some of it will be informative, maybe not all of it, but some of it. Um, I do have some house cleaning details that I'll cover later, but right now I think I want to welcome all of the new people. I think we've got somewhere in the range of 25 to 30 new people who've never been with us, either in person or virtually. So welcome to those folks. Glad that you took time out of your day to be with us as well. I am pleased to be on the call with you guys and listen to what Darwin has to say. Darwin and I have been friends for many years, and I respect his business acumen, his all the accomplishments that he has had over the years. And I will turn it over to him shortly. And so, without further delay, Darwin German.
Hello, everybody. Hey, Mo, are you going to start the presentation? All right, go to the next one. Interesting thing, give you a couple updates on some stuff. It is really funny. Today, I spoke on an online podcast and live event, which I think there's a few of the people that were on that today, where I was interviewed by Tim Mai or May. I don't know. Tim Mai. I really don't know how to say his name. MAI. And he's got a podcast and he's doing a fund of funds, etc. And I was honored to go ahead and speak to his group today and give them a rundown of what we do. And some of them have joined us. So thank you for joining us. And them, as well as anybody else that is new, stay afterward so that we can go ahead and meet you virtually. Next month, our meeting will be live, so that will be much better. And here's the quote by Sir Francis Bacon. We provide expertise in acquisition and operations for multifamily investments, but knowledge is power, is what he says. Okay, let's go ahead and skip. We've done $1 billion transaction, been around 30 years. We do our own in-house property management. We minimize risk and maximize our returns as much as possible. Next. Here is our team, so you can see all the faces. And for some of you, the first time ever seeing Brian Johnson's picture on here. So myself, Julian, Garrett, Jeff, and Mo up on top. And Brian Johnson, our in-house general counsel, who lives in Wisconsin, and he's really the man behind the curtain that is looking over all of the details, making sure we stay legal. Looking ahead. He also handles taxes and insurance. And then Jenny Rosario, Director of Operations, and she comes with a ton of experience running some other management companies, and she is absolutely brilliant. Of course, Juritza's been with me forever, and she helps run everything along with Paula. And those three together pretty much supervise all of the properties on the property management side. Extremely important, extremely thankless job, hard work, low margin, pain in the ass, 24 hours a day, and they work their butt off to go ahead and take care of the assets that we have. Numbers don't lie. The right assets thrive in any economy. Absolutely. And we've got some good numbers for you here later on. It's just our simple business plan where we buy the property, turn it around, maximize NOI, refinance. We haven't had many refinance opportunities lately because there's not been a lot of value add. However, next week we are closing on Vitae, which is a value add deal in Denton. A great deal, 90 units, student housing. But it is a great deal. We're really thrilled to go ahead and finally get closed. And again, you can look at this. This is all on our deck. A couple of the key components. Transparency is one of the biggest items. You trust us with your hard-earned funds, and we need to be transparent in everything we do. And I think we do a pretty good job at that, and an open book wherever possible. Here is our 2023 report card. Okay. If you look, and we did this presentation back in January, and we wanted to look at a report card. How are we actually doing with all the doom and gloom and everything that's going on in the marketplace? And they say rents are down in some areas, up to, is it 1.8 as a max on income year over year? Well, we took the properties that we've owned and have 2 years worth of operating history and compared November year to date, November T12 of 22 to November T12 of 2023. And the reason we use November is just because we did this presentation January 5th or so, and we did not have year-end financials. But comparing those, the average, we've owned these assets an average of 40 months, and current occupancy 94% when we did this at the beginning of January. And here's where it's exciting. Our November rent, average rental rate was $13.30, and the average is now $14.62. So that's a 9.98% growth. Income, collected income went up 9.19%. Our pro forma, let me jump down to the next one, 2022 NOI versus 2023 NOI, that went up by 10.32%. And then that third one, 2023 income pro forma, that's our actual 2023 income versus our pro forma income, so which was done on average 40 months ago, and we're beating that by almost 6%, considering a down market the last 2 years. This is, or year and a half, this is a great report card. We're very proud of this. We are actually getting higher rents on our renewals than we are on new leases. So really a big part of our focus is on property management and resident retention. Part of that resident retention is employee retention as well. We'll get into that here in a minute. Okay. Past performance. Now, these are all of the syndications we've done that have gone full cycle. Okay. It means we bought it and sold it. And this shows our return. The second to last column, estimated annualized return. That's our average annual return for each property. Interesting though. Are you on two at once? That's interesting. But this is our overall return. If this is the partner level. So the average annual return on the partner level, 32.62%. And that's what the partners have made on all of these deals on average. And that's why we say invest in a few deals. You don't know which ones are going to be home runs, which ones are going to be base hits. And again, past performance, no guarantee of future success, but we definitely want to share what we did on all of these different assets. It all says when we bought them, when we sold them, how many months we owned them, et cetera. So this is a great slide. We're very proud of this as well. General updates, which we talked about this. We used to be live in person, where everybody can come to the meeting in our office in Las Colinas. We've switched that to quarterly. So again, that's why everybody's on Zoom. And I know at least one person went to the office today, which is very funny. Read the information. But then, so next month we'll be live in our office, January and April and July and October will all be live in our training room, but we will also still broadcast that. Okay, next one. Vitae. Let's talk about Vitae for a moment. Before I hit that real quick, I want to go ahead and tell you something interesting. The reason we normally have our meetings on the second Tuesday of the month. However, this being the third Tuesday, and that was because I was the main speaker at another event that was going on last week for a new investment group that just expanded to Dallas, and they've got an office here in Las Colinas as well. And they had me speak. It was very nice. The guy that runs it has been, he said, chasing me for 4 years to join his group, and we did that, and it was pretty funny. Something that was heard is when we put up that last slide showing our performance history. Somebody even said, I mean, you could hear him say it. He looked at that and went, holy shit. And so that was pretty funny, considering that there's not a lot of people with the amount of experience that we have. And that's not even all of the different transactions and the ones I've done on my own, et cetera. Those were just the syndications. And we've done development, we've done industrial, self-storage, office, obviously. And so we've done real well. So
Hey, Doc, we even threw in the one stinker in there as well.
yeah, I pointed that out, that we showed the one negative that was in there, which I said most people don't share their troubles, and instead you end up reading about those in the newspaper when it comes out. Also, if anybody reads The Real Deal, Julian doesn't know about this, but I've got a discussion tomorrow with The Real Deal about having an article on innovation in property management and investing, and a good counter article to all the ones that have been published regarding properties failing and getting foreclosed on, et cetera. But jumping back to Vitae, you can go ahead and scan those things for the property tour or the financial analysis, and those are our videos. The property tour is a video that we do, and it's the pretty, right-brained, I forget right brain, left brain, right-brained, the pretty picture, shows you the inside, a tour of the property. And then for those engineers and numbers geeks like me, the financial analysis, where we go through all the detail, so that you understand where those numbers come from and how we come up with our analysis and our returns. So that's pretty exciting to go ahead and have. So go ahead and take a look at those. This was an article that came out today. And Vitae is a student housing deal. It's our second student housing deal that we're doing. And it's here in Denton. And they're talking about how student housing is going great. The income and rent is up between 5% and 9%, depending on which market you're in. And so we projected like a 4.1%, and all the leases renew in September. They're already 62% pre-leased with renewals for September, with a it's in there. Okay. Already pre-leased for September. 62% is already pre-leased, and it's at a rate higher than what we projected in our projections. Built in 2016, $135,000 a door. Absolutely great deal. And I think we're pretty much fully funded on that. Maybe we have a couple $100,000, maybe. You'll have to reach out to our investor relations to know if there's any room left on that, but I think it's full, and we're closing on it. We're scheduled to close next week. Okay. Also, this is also fun. I want to go ahead and talk about this. It's a little bit off track. Last week I spoke at that event. Earlier today, spoke at another event. And I also met with one of the gentlemen online, Eric, invited me to speak at the Park Cities Rotary Club with a couple hundred members, and do that presentation. So thank you so much, Eric, for that invitation. So I want to go ahead and throw this out. If anybody would like me to come speak at any event, I am more than willing and able to go ahead and do that. And even if you wanted to get a small group together, then let us know, and we will come and present at that as well. It's all about growing our business, getting more investors in, making them money, and showing them how they can still survive and thrive even in a difficult market like this. All right, management updates. We are seeing, obviously, there are challenges. Costs are up, payroll is way up. COVID era policy with agency debt, we can't do a 3-day notice to evict. We have to do 30-day notices. So those 30-day notices, just to give you an idea, we used to be able to do a 3-day notice. They don't pay after those 3 days. We go get a writ and evict them, and they could be out within 2 to 3 weeks. Now, if they don't pay on the 4th, we give them a 30-day notice, which means we can't even file for eviction for 30 days. So the following month on the 4th, and at that point in time, they're 2 months behind. And then, even then, we go to court, and the courts are doing everything they can to defer the eviction. And the idea is they don't want homeless growing, so they'd rather put that back on the landlords to somehow work it out, et cetera. So they're deferring, denying those evictions. And even when you do everything perfect and they grant the eviction, then even if they do grant in our favor, they tell that resident, oh, you can go right down the hall and file an appeal. So the courts are not being our friends. And so we've got to make sure that everybody gets out and votes for pro-landlord judges. And that's something nobody ever really looks at to vote on. But those are taking over and creeping in. Everything is moving slow, just like Vitae. We put this property under contract back in like October. And it has just been so slow, but also this seller has been the most difficult seller and management company. They just don't care. They've been very difficult. They don't even have out January financials yet. So how'd you like to be an investor with them, not even getting financials out for so long? We've been in the slow leasing season, but in May that starts picking up. So that'll help on our occupancy. We've got some dips in a few areas. And another challenge that we have is that applicants are falsifying documents. They are making up their proof of income. They are making up their rental history. They are just lying on all these applications just to get in. And then it's extremely hard to get them out a lot of times. So those are some of the problems on management. However, that also gives us some opportunities. Number one, residents retention is key. We need to really, really focus on resident retention. So we are doing more resident activities. We're getting them engaged more. We've hired people to monitor all the Google reviews to get those up, because most people are finding those online now. So, and they're always checking those reviews. So we are addressing those very proactively. And part of a key to resident retention is employee retention. So anytime there's a change in staffing, it raises questions from the residents on the stability of the property. They usually leased from a leasing agent in the office or manager that if they're gone, then they kind of go, well, what happened? I was leasing partly because of that. So employee retention is critical as well. And as part of that, we are doing a lot of employee, just like resident retention for resident activities, et cetera. We're doing the same thing for employees. As an example, we took the maintenance staff to the Mavericks and Denver game Sunday, rented a suite and took all the maintenance guys, and they got to bring somebody. Most of them brought their kids, and having the kids in there enjoying it. And the whole idea is to build that camaraderie, because especially on the maintenance side, they'll leave for 50 cents an hour unless they really love where they work. So we're doing that. We are also looking at setting up a Dave Ramsey style financial program for the employees to help them manage their money better. And also, something that I did back in 1996 is we reorganized the management company so that properties were not standing on their own. They were managed as a portfolio. And when you own or manage, you can do that a lot easier. And in that reorganization, we centralized the management. We got rid of assistant managers on the property and brought them in-house, so that, because they're the people that sit in the back of the office, do the paperwork, et cetera. Anyway, so we brought them in the office where we could have fewer on-site assistant managers so that we can save on payroll overall, but then we still have to bill that back through the properties to the management company. We're also doing the same thing with invoices, with marketing, and we're looking at doing it with leasing and with potentially our monitoring, so that we can have that in-house. All that is a little bit higher expenses, but the whole idea is resident retention, employee retention, and getting all of the employees on site to focus on customer service, resident retention, taking care of them, and take the business aspects off site so that we can be more efficient and provide better management services. Okay. Next. Market update. So what the heck is going on? Next. We're finding that there's very few foreclosures that have been happening. We were looking at this, anticipating absolute blood in the streets. We were anticipating blood in the streets during COVID and people not paying rent. That did not materialize. Then the interest rate hikes and properties that can't afford their variable rate mortgages or interest rate caps, et cetera. And all because of that, we thought there would be a lot more defaults and a lot more foreclosures. However, there's only been, I don't know if it was 4 or 7 in DFW so far this year that have been foreclosed on, because banks are working deals out wherever possible. It's extend and pretend. So even if the loan comes due, they say, you know what, there's not liquidity in the market and you won't be able to do it anyway. So if you're still paying and your loan is still current, they'll kick it forward. The biggest people in trouble are the small syndicators that go in there underfunded. A lot of syndicators, their business model was go in, buy the property, only fund a little bit of the CapEx so that they can fix up some units to prove that they can raise rents, and then flip it to the next person, showing them how they can raise rents and make more money on it. Well, that means they were underfunded when they went in there. They were also planning on a very short-term hold, so they got short-term bridge loans, and those bridge loans are invariably always a variable rate mortgage. And so because of that, those are going upside down. Then the interest rate caps they have to buy put it further in trouble. And then even if, for example, I was talking with one group today, and the lender was willing to go ahead and just take the property back. Just, you give the property back, walk away, no big deal. But they ran a title report and they found that there were hundreds of liens on the property. Because of those liens, they have to foreclose to wipe those liens out so they can actually sell the property. So it's those small syndicators that are the most in trouble because they went in underfunded. They don't have the clout with the lenders to negotiate or do something with them. They don't have the ability to raise more money to recap to get out of them. And the ones that are holding on just by their fingertips are hoping that interest rates go down. And until then, because of the higher expenses and mortgage, et cetera, they are not improving the properties and in a lot of cases not maintaining them properly and not paying the bills. Those are not problems that we have, thank God. And so that's where the biggest problem is, small syndicators, and there's going to be more of those coming down the pike. So if you see any deals that we can help out and of course do something not just out of the goodness of our heart, but it is a money-making venture to go in and help some of those or buy some of those properties. So if you see any of that, definitely let us know. But bottom line is the market is tough. You know about interest rates. Everybody feels that. Everybody feels the inflation. And we're just all hoping and praying that interest rates go down so that things don't get worse. However, if you go back and look back in history, we're still a little bit below the historical averages as far as interest rates. So I'm not overly optimistic about too much of a drop in interest rates, maybe a half a point, maybe 3/4, as far as the Fed funds rate. But that will also help spur the market ahead too. We are selling our property down in Fredericksburg, 1019, and that property is under contract. Non-refundable earnest money is already up. They're in the process of doing this, and as of right now, the potential of an end of April closing. They are assuming our loan, which is only about 55% loan to cost, but it's at 3.11% interest and has 8 years left on the loan. So we don't have to sell this asset. We're in good shape, making money, everything else. But a big part of the reason why we're selling this is there is a whole lot of competition coming in down there in that market as far as new builds. Another benefit that we had there is that tons of the properties, and there's not a lot of rentals there because everybody uses them as Airbnbs, because for those of you who don't know, that's the wine country of Texas and a great place to visit down in Fredericksburg. And we had 4 units that we were using as Airbnbs, and they're not even staying as full as we would like right now. But a great asset, great loan, and some buyers that we know are buying it. And so I think it's going to be a great deal for us and for them. On that same note, let me bring up another property. I don't know if we have a slide for it. Mustang Ridge. Everybody saw Mustang, right? Mustang Ridge is out in Weatherford, brand new construction. It was completed in 2021, leased up in 2022. The sellers were offered $108 million for that property in January 2022. They turned that offer down because they developed it, they hold longer term, and but because of interest rates and them having to move money around, et cetera, they went ahead and sold it, and we bought that deal. Again, they were offered $108 million and turned it down. We paid $70 million for the property, $200,000 a door, roughly. And that's below replacement cost for brand new construction in Weatherford. Now, here's the kicker. The seller, because it was a $36 million capital raise, and we came down to closing, and we needed $4.7 million more to close it. And we said, hey, we need more time to go ahead and do this, or we're going to have to walk. We just can't get that 4.7. The seller said, look, we'll go ahead and kick in for that. You can keep raising money. And in that scenario, we wanted to raise additional money. Well, we haven't haven't gotten to the point of having that work to raise money for that property yet. So this is a last call for alcohol scenario. This is your last call because you can still invest in that deal. It is for accredited investors only, unfortunately. It has projected returns in the 16-17% range, projected returns over 5 years. And the big benefit that you can get, because they have not recorded their tax return yet, they will basically sell their shares. They will sell their shares to you, but backdate it to the purchase date that we bought the property. So you can still get roughly 50% bonus depreciation, even though we're at the end of March. You still have the opportunity to buy those shares from the seller, from the people who did that, and get into a great property that has projected great returns and get 50% bonus depreciation year one for those that need it for their deductions for last year. So definitely reach out to our investor relations team on that. Anything you want to add to that, Julian?
No, that's pretty much it. I'll make a small correction. My understanding that the offer that the sellers received was 103 rather than 108. But either way, it was significantly higher than what we acquired the property for. But yes, reach out to us, take advantage of some bonus depreciation, and the window, as Darwin said, is closing on that.
Absolutely. Okay, let's go to the next, which you're going to handle anyway, Julian.
Okay. Speaking of bonus depreciation and anything tax related, this is tax season. K1s have all been uploaded. Excuse me, have all been uploaded to the portal. As usual, we do get some inquiries where people don't quite know how to find it or what have you, but everything's uploaded. I believe pretty much everybody's gotten theirs. We did have to reissue K1s for the Oakview property. For those of you who happen to be in the Oakview property, we had to upload new ones for that. There was a small error in the amount of the distribution. It was less than $200, but we want to be accurate with our numbers, so we reissued new ones. And I will ask that for those of you who are inquiring about K1s and 1099s for the partner loans that we've done, Mo, you can move to the 1099s. Sometimes
real quick, Julian, real quick.
What's
I got
that?
to take a break, so you handle everything for a minute, and I'll be back.
No worries. A lot of you have reached out and haven't received them, and it turns out because the address was wrong. As people move around, they either forget to let us know that they have moved, or after they've told us or gone online and done it themselves through the portal. Unless we were notified, we would not have known. Our system doesn't automatically ping us to let us know that you've changed your address. So therefore, this year's were addressed to the property or the address of record from the previous years if you're in a multiple year investment. So if you do change your address, if you do move, please let us know via email, and we will make sure that future paperwork such as 1099s and K1s are properly done. I will also tell you that K1s are uploaded to the portal. However, the 1099s are actually mailed to your residence of record. So doubly important for the 1099s. I think we've covered pretty much most of the ones that we had inquiries on, but yes, definitely let us know if your address changes. And speaking of that, Mo, if you go to the next slide, this handsome young man is our newest addition to our staff. Jeff has come on as I won't call him an intern because he's actually an employee, but he is on board to do a lot of little special projects. And I have him as a special project to reach out to all of you if there are any missing items of information on your record, such as a phone number or an email address or anything that needs to be corrected or inputted that was missing. Jeff will be reaching out to you. So if you get a call from someone named Jeff Smith, not Jeff Young, but Jeff Smith from Darwin German Real Estate Investments, it is not a scam. It is this gentleman here, and he is working on getting our records as updated as possible so that we don't have any of those issues with the wrong address or maybe a phone number that's been changed. And even in these days when people have their phone number portable, you can take it from carrier to carrier or state to state. Some people do choose for one reason or another to get a new number and sometimes forget to let us know. So he will be reaching out to those of you, and just be aware that he would be calling and it would not be a scam. Let's see, what do we got after this, Mo? Okay, well, again, I want to thank everybody who joined us that has never been to one of our meetings or one of our Zoom calls. If you do want to learn more about who we are, what we are, and all things DGRE, just reach out to Jeff Young, Garrett Stroud, or myself. We'll be happy to take your call, spend whatever time you would like to get your questions answered, and see what benefits are available to you through becoming a partner of Darwin German Real Estate Investments. This is our contact information. All our email addresses are at darwingerman.com. So it's Julian, Garrett, or Jeff at darwingerman.com.